Hey everyone, welcome to The Explainer. Today we're opening up the books on a really fascinating puzzle in the financial markets, Ryman Hospitality Properties, or RHP. If you love a good corporate mystery, well, you're in exactly the right place. We're going to look strictly at the raw financial data to see if we can untangle one of the most compelling valuation discrepancies out there right now. It's a wild story of incredible historical wealth generation just totally clashing with some pretty glaring modern red flags. So get focused, pay close attention, and let's unravel this whole shebang together. Okay, let's dive into this. 37.1%. In the world of value investing, you guys, this number is basically a giant flashing neon sign. This is Ryman Hospitality's current margin of safety. Now, for those of you who track discounted cash flow models, you know this means the stock is trading at a massive discount compared to the actual cash that business is projected to generate. I mean, a margin of safety this high? It's super rare. It provides a massive theoretical cushion and practically screams that the market is undervaluing the stock. To put some real dollars and cents to that percentage, take a look at this. Right now, the market is pricing RHP at $106.22 a share. But when you crunch the numbers on their discounted cash flow, the fair value price sits way up at $168.87. That is a staggering gap. It's incredibly tantalizing to see an asset seemingly put on the clearance rack by the broader market. But as we know, in finance, things are rarely that simple. We really have to ask, is the market missing something, or are the algorithms missing something? So let's get into Section 1, the valuation mystery. Are we looking at a hidden gem or a value trap? Let's look at the price-to-earnings ratio, which currently sits at 28.79. On its face, a PE of nearly 29 is fairly standard for a growth-oriented company, though, maybe a bit lofty for a traditional real estate or hospitality play. It tells us investors are willing to pay roughly $29 for every $1 of current earnings. But context is absolutely everything when you're evaluating a stock's true cost. A standalone number doesn't really tell a story until you compare it to its own history. And this brilliantly illustrates our first major pivot. Yes, the stock is trading at a 37% discount to its discounted cash flow fair value. But actually, its current PE ratio is running 22% higher than its own 3-year average. So relative to its own recent past, you're actually paying a premium for Ryman's earnings today. It's this fascinating contradiction, right? It's undervalued by cash flow projections, but overvalued by its own historical earnings multiples. Moving right along to Section 2. Growth and historical returns. Let's look at their historical performance. Now, the top-line growth is undeniably impressive. Just look at that 5-year revenue compound annual growth rate, a massive 37.47%. That shows some incredible expansion. But I want you to direct your attention to the bottom line, specifically the trailing 12 months, or TTM, net income. We're seeing a concerning drop of 10.39%. When your revenue is growing but your net income is dropping, it almost always signals margin compression. It basically means it's costing them more to generate those sales, and the actual profit left over for the business is shrinking in the short term. This is for sure a very clear red flag. But let's move forward and see how this builds a case for the long-term holders. Look at these historical total returns. Over a 5-year period, you've got a 51% return. Over 10 years, nearly 200%. And over 15 years, a massive 525% total return. This completely visualizes undeniable, immense long-term wealth generation. For investors who bought in a decade ago and just reinvested those dividends, Ryman has been an absolute powerhouse of a wealth builder. But of course, growth is never a straight line, especially not in the hospitality sector. This timeline shows the extreme yearly return volatility, particularly in the post-2020 era. I mean, we see a near 20% drop in 2020, followed immediately by a 35% surge in 2021. Then another 10% drop in 2022, only to rocket back up 40% in 2023. This really drives home an important lesson. Investing in this asset requires a very strong stomach. If you're easily spooked by year-to-year swings, this level of volatility could easily shake you out of those massive 15-year gains we were just looking at. All right, Section 3, the dividend draw, an income magnet. On paper, this is basically an income investor's dream scenario. The stock currently offers a really juicy yield of 4.52%. And even better, management has delivered 4 consecutive yearly dividend increases with a trailing 12-month dividend growth rate of 4.35%. It pays well, and the payout is steadily growing. For anyone looking to generate passive income from their portfolio, this makes a highly compelling case. But then we look just a little bit deeper into the data, And we hit this, frankly, terrifying number, 125.95%. This is the company's free cash flow payout ratio. So the crucial point is this. Ryman is currently paying out significantly more in dividends than the actual free cash flow it generates from its business operations. Free cash flow is literally the lifeblood of a company. It's what's left after paying operating expenses and capital expenditures. A ratio over 100% means the dividend just cannot be sustained indefinitely by the core business alone. They're either dipping into reserves or taking on debt to maintain that attractive yield we just saw. This makes the dividend highly vulnerable if operations don't catch up and fast. Let's dig a little deeper in Section 4, Financial Health, under the hood. Let's start with debt. Right now, the debt-to-equity ratio stands at 5.30. In isolation, having over $5 of debt for every $1 of equity sounds, well, very intimidating. But consider the historical comparison. The 3-year average for this metric was 9.63. So while 5.30 is still heavily leveraged, it actually represents a massive, nearly 45% improvement. Management has obviously been doing some serious work to deleverage and clean up that balance sheet. To summarize this complex financial picture, yes, the overall debt burden is shrinking dramatically, which is excellent news. However, short-term liquidity leaves a bit to be desired. The current ratio sits at 0.66. A current ratio below 1.0 means the company currently has more short-term liabilities coming due than it has short-term assets to cover them. It's a really tight squeeze. They're basically wealthy in the long run, but kind of cash poor in the immediate term. Which brings us to Section 5, the final verdict, weighing the evidence. Now, what's really interesting about this is how perfectly balanced the arguments are. Look at the bull case. A massive 37% discount to fair value, an incredible almost 200% return over the last decade, and a rapidly improving debt-to-equity ratio. But the bear case? It's just as robust. You're paying a premium PE compared to its recent historical average, net income has dropped over the last 12 months, and most terrifyingly, they are paying out 126% of their free cash flow just to maintain that dividend. It is a literal financial tug-of-war. Which leaves us with one final question. Is a 37.1% discount enough to outweigh the very real financial risks under the hood? Does the historical wealth generation and improving debt justify the tight liquidity and that unsustainable dividend payout? It's a textbook value investor's dilemma, balancing the allure of the margin of safety against the harsh realities of the balance sheet. Take these data points, apply them to your own frameworks, and see where you land on the mystery of Ryman Hospitality Properties. Thanks so much for joining me for this explainer, and keep learning.